Welcome to StockOdds, Odds and End podcast. I'm Dave Singh here with Rob Friesen, trying to find some quantitative edges for the week ahead using StockOdds data. Hey, Rob, how's everything this evening?
Hey, nice little jingle in the background there.
Yeah, we got to make it a little more interesting.
Yeah, we
It's
did.
going to lighten up after that big 1,000-point decline on Friday. We need something.
Yeah, we do have to brand ourselves too, right? We should have someone, create a little jingle for us. Maybe even some words. Who knows?
Good.
All right.
Well, I mean, we just come off a big week here with markets down big on Friday. We sold into that close. We've had a week and a week month, almost the inverse of what we saw in March. We kind of had a reverse V-shaped pattern on the chart there for the spider, and we're coming into the last 5 days of April. The VIX is creeping up again above 28. Oil's still around 99. The 10-year is 2.9%. So all those things out there, and what does the data say we should do in the week ahead?
Yeah, well, so what is the last 5 days, 3 days, and the last day of the month on the seasonality calendar?
Oh, that starts tomorrow. I mean, that's the last.
Yeah, but what's the performance expected to be?
Oh, yeah, right here we have that. Well, I have the breakdown of all the sectors too.
Okay, why don't you run through that?
Yeah.
If you need a moment, I can go first here.
Yeah, go first. I'm gonna pull up.
Okay. Well, on the front of what's happening here with the futures at the moment, so the Dow Jones index futures are down 249 points at the moment, 0.74%. There's a good distance between here and the February low, which was on 24th for the Dow Jones futures. So it's different for the other indices. And then we had a higher low on March 8th and again a higher low on March 16th. So the first target is probably the March 16th one if we want to continue to fall, but certainly stronger. And that does argue that there is a value proposition that there might be some rotation out of high PE stuff and riskier assets and into more defensive positions. That's what it is saying. If that Dow 30 is holding up better than the other ones. The next best performing is the S&P. That's down minus 0.77 or 33 points. And again, it had a higher low on March 15th, and the February 24th was lower than that. So a bit closer to it than the Dow. Then we go to the NASDAQ 100, which is getting really close to its March 15th low, which was actually lower than the one on February 24th. And so we're approaching that pretty quickly here. There's only, 260 points or so to go to hit that. The Russell is really close to its lows. It's got kind of a channel. There was a lot of, kind of support indicated in that area, and it's getting really close. It's down 17 points or 0.88%. The NASDAQ is down right now 0.78 or 104.50 at the moment. We've got the Nikkei was off 0.75, 200 points, and DAX is 1.67, minus 237. We'll see how Europe plays overnight here and before our market opens, see where it's at. VIX, as you mentioned, Dave, that's rallying again, up 0.66 or 2.37%. So we're already back to 28.65 on the VIX.
Yeah.
So with no sign of slowing down on this move here. So that's what's happening in futures land. And if we move into metals and so on, their gold was off on Friday. We'll have to see how the gold futures are doing here. 0.57 down, minus 11. I'm writing a kind of a bit of a write up on gold as something of interest to me. I think that I can come up with about 20 reasons why there might be a reason to get involved here shortly. And so, you know, against the major narrative, if you look at the consensus, most people don't give gold 2 hoots worth of value, right? But I do see that there's an argument for it. So I'm going to write up that, and that kind of includes silver and copper as well. And they've been, like, they were down last week pretty bad. But my argument is, hear me out. My argument is not on the defensive thing. That's the US dollar right now, and you know, value stocks and things like that are more defensive, but these commodities are not. But there's a whole different aspect of why this thing could turn around in the future very quickly, and it has nothing to do with it being a currency or a defensive, you know, sort of fear-based product. Okay.
Sure.
So let's see, currencies right now. The U.S. dollar is you know, making new highs, not on the monthly or weekly, but on the daily. Over the last year, it's definitely making new highs, and the weekly is coming up to. It's getting closer and closer to some matching highs we had on the weekly. And even on the monthly. And then there's a bit of an air pocket where it can go back towards 2000 to 2002 highs. So if it pops above this channel that it's in, it hasn't been there since, you know, 20 years ago.
Yeah.
So actually, there's a lot of things that we haven't seen for 20 years. Actually, there's a lot of things we could check off our list. It's like, haven't seen this for 20 years. But anyway, let's roll over to you and talk about some things you see here.
Yeah. So you asked, how does the spider do in the last 5 days? So the last 5 trading days, the spider is expected to do 0.54% return. But of those 5 days, the last day of the month is actually a down day, minus 0.36. And the last 3 trading days of the month are only 0.19% return. So it seems like all the return, it's going to be front loaded on the first 2 days of that 5-day window. So that's something noteworthy. I looked at the almanac to see what kind of sectors were showing that they might outperform or underperform the spider in that 5-day window. And I'll just rattle off some of the ETFs that we see for outperformance. One was gold. I mean, the fact you said you're interested in gold. Gold was expected to be an outperformer of the spider, while silver was expected to do about the same exact performance as a spider.
Right.
Let me
pause and interrupt you for a minute. And this is why we stress so much, you know, not to just take a single directional approach, but to really exploit relationships and look at the performance of one versus the other. And I'm so glad you brought that up. It's like, you know, to be like here's an example. Gold was down on Friday, just like other things were down on Friday, right? But was it down as much? Or were defensive stocks down as much as the high PE, speculative, no earnings or whatever type stocks? Do you know what I mean? It's about that relative performance. If I could drill that into people and say, stop being so directionally minded, like either it's green or red, and start being blue, like relative performance between things.
Like even the GDX and SLV, right? So the last 5-day window, the GDX is expected to do 1.62%, while the SLV is 0.54, the same as the spider. So being long GDX minus SLV could be a trade for each day even. I mean,
yeah. Well, the problem with oil is, like, you know, do we go to, you know, 150 or 185 or 200, or do we go down to 80 or 60 or 50? Like, there is a supply chain problem on oil, but it's such a weird environment because, you know, OPEC could come across and I'll suddenly say, hey, we're gonna, put a whole bunch more on the market or whatever, and all of a sudden oil's off like 8 to 10% for that day, right? Or it could be another threat of even worse things to come out of the war, and all of a sudden oil takes off on an upside. So it's really a tough environment to get right all the time right now. I do expect that there's more upside potentially to come from oil, but how do you get there? What's the path to that?
Yeah. So also I'll read up more of the ETFs. So materials, XLB, these are the outperformers. So XLB, XLC, XLF, financials are expected to outperform quite a bit relative to the spider, including the KRE and KBE, so the regional banks as well. Even utilities, consumer discretionary, energy, real estate, the home builders, XHB, and even some of the individual big cap stocks like Apple, Tesla, Microsoft, and Amazon. So those are all the big outperformers. And the things expected to underperform the spider are small caps, the IWM, the NASDAQ itself, QQQ, the diamonds, industrials, XLI, XLP, staples, and healthcare quite a bit, XLV, XBI, IBB. So those biotech and healthcare are expected to be much weaker than the spider. SMH, or the chips, that also came up. And things like the ARK stocks, ARK-K, ARK-G, those are also expected to be poorer than the
Yeah, and just a reminder to people that like ARK's supposed to be down on the last day of the month there too. You can use SARK as a long, which is the inverse of ARKK.
Yeah.
So that's one way to play it. But I want to interject here and just talk about the earnings that we have this week, because we've got Microsoft and Google on Tuesday, Facebook Wednesday, Apple Thursday, as well as Amazon after hours on Thursday. These are the biggest stocks in the SPY, the S&P 500.
Yeah.
And we have we've had about 20% of all the stocks have reported so far earnings out of the S&P 500 stocks, and they 79% of those beat earnings. But it doesn't necessarily mean just because they beat earnings that they contributed to the market going up or they went up themselves, because markets looking forward and go, that was nice, you beat, but you know what, things are going to get much worse for you the next time. So it's not a guarantee, but if these earnings come out pretty good, it could help that SPY to perform better than the IWM, like you were saying. So there could be that contributing factor. So it's going to be interesting how these things report and what that means for the market this week. Okay. Yeah. So we've got 180 stocks to report this week.
Wow.
Right. So along with these big guys.
I think that means a lot of vetting in the morning pre-market to look for things that are reporting, maybe to exclude from your trades each morning.
Yeah, see what that's giving you, and those are going to impact the tech stocks for sure. If Apple is not doing well, there's not much hope for too many other things to perform, right? So, but that's on Thursday, right? So, and then Friday we have a personal expenditures index. That's called the PCE, and that's really a big gauge for inflation. And so we'll have to see what that trend that's the last day of the month. There is a lot, not only the earnings side, but there's a lot of economic reports this week too. Thursday's GDP, Friday employment costs, personal income, all kinds of stuff this week. You guys can look it up because there's just way too many things to report. So definitely a week to be careful, as Dave said, about vetting your symbols and looking at your economic news. Most of that hits about an hour before the market opens, the early stuff. Yeah, so that's what I see. And then the other thing is, be careful that you don't just arbitrarily trade some Chinese stocks. There's some real issues going on still. We're not out of the woods with China. The lockdown in Shanghai and in other regions is extremely aggressive, and that's affecting a lot of things. And then you have, I don't know why they tend to fight so many fires at once, but Xi's going after corruption again, and in his 10 years of tenure here, 1.5 million government officials have been arrested and charged with, corruption. 1.5 million. Wow. And there's, 40 new ones just come out over the weekend here in banking and finance companies and all kinds of stuff. So they're pulling out all the stops over there, and I just think China is just so risky still. The time will come probably when the bottom's in and there's some potential for some of those stocks, but you're probably better off to do your homework within the S&P 500 and the better of the NASDAQ and the better of the Russell even, right? Safer.
Yeah.
So you have things like, you have things being delisted, moving their listing from, being NYSE ADR, moving over to Hong Kong or whatever, some of the Chinese stocks. So there's a lot going on there. And I think that also overall is a bit of a downward drag. We've got a lot of downward drag. So I know we've had people that say, we have to be bullish, this is a great time to buy and all that. But this is a really precarious year, and we have seen markets climb the wall of worry before, but there's just a lot going on and a lot that hasn't happened in so many years. Like, would you have thought as you rolled into this year, you'd now be, kind of like World War II again kind of thing going on? Yeah. And some people have said, well, isn't this the start of World War III? I don't know. But I mean, there's so many unexpected events going on. And then, so Macron won the election there, and so that's not too favorable for Putin. So we'll see how that plays out.
And Ukraine's going into what, third month now, the war? It's dragging.
Well, wasn't it February 24th or something when it started?
Yeah.
Right. I mean, it was building up before that. The market, had already rolled over, and that's the other thing. I mean, we've come from such lofty highs in the market that, there's still a lot of downside potential. I don't know that you can say that we're out of harm's way and the bottom's in on the market overall, right?
Yep.
And so, did you know also that we haven't had more than a quarter basis point hike since 2000?
That long.
All of the measures were quarter, and now we're talking about May 4th being a 50, right?
50, and I heard 75 points here and there.
Yeah, I probably here's the thing. You got to factor in a little bit of all the crap that's hitting the fan. And, to do a 75, I mean, when they have never, they've only done quarters and now they're going to do a 50. I think that's enough. I don't see, I think that 75 is somebody trying to, get extreme, and if it happens, they'll certainly make their mark, but I don't know.
Well, the market's already done the work for them. We're at like 2.9%.
Yeah, exactly. Yeah, market's doing a lot of the work too, right?
Even just the thought of it brought us to that level. So,
yeah. One thing on the, the dollar has continued to gain strength, as we mentioned, and so commodities should be weaker with rising dollar, but any that are holding up and moving in the same direction as the dollar, that would mean that they're even stronger than you think, because normally paper is short when the dollar's going up like that. So because the commodities are priced in U.S. dollars, right? Anything else that you see?
No, I mean, like you said, there's a lot going on this week. Economic reports, earnings, and the seasonality all in the same week. So I don't think it's going to be one thing or the other that's going to drive stocks. It's going to be multi-factor strength or weakness on each symbol.
Yeah. Yeah, definitely, especially your biggest market caps, which can impact the market and the smaller ones as well. Really dial into your earnings calendar. I mean, Coca-Cola starts it off before the market on Monday, but Pepsi's on Tuesday before the market, and then after the market, we got Google and Microsoft. So that'll probably the pivotal. You know what? I think if we open down, and let's say Coke reported good earnings, that's defensive, right? There's a chance that the Dow could hold up reasonably well compared to the tech stocks on Monday. And then on Tuesday we've got Pepsi and GE before the open.
Yeah.
And so there's still a lot of play left there before the market close, and then we get the Google and the Microsoft.
Yeah.
And Visa, Capital One. So okay.
Good.
All right. Well, good chatting. It's always nice to just go through things and get our bearings. And
we had our intro, so you get a 10-second outro.
Oh, okay. Do the outro.
All right. Catch you next time.
Okay.